Hello, everyone, and a really warm welcome to you all.
Yeah.
Seriously, thank you so much for coming and watch the video today. We have a massive update to get into. Netflix just dropped their financials and a shareholder letter for January 2026, and honestly, it's this wild mix of like everything is perfect on one side,
Right.
and we are betting the entire farm on the other.
It really is. I mean, on one hand, you have a company that is just operating at peak efficiency,
Mhm.
but then they're leveraging all of that stability to fund this massive, this really high-risk acquisition of Warner Bros.
Okay, so before we get into all the merger drama, let's just look at the scoreboard for Q4 2025. Because usually these reports can be pretty dry, but these numbers are, well, they're screaming efficiency.
They absolutely are. So revenue is up 18% year over year.
18%.
Yeah, hitting $12.05 billion. But, the number that really jumps out at me is the operating margin.
Okay.
It expanded 2 full percentage points, all the way up to 24.5%.
And that's the key right there, isn't it? They aren't just growing the top-line revenue, they're
Yeah.
actually keeping more of it.
Exactly. And the net income cleared $2.42 billion with an EPS of 56 cents.
Wow.
And they're really bullish on 2026. They're forecasting over $50 billion in annual revenue.
50 billion.
And they expect margins to climb past 31%.
So they have this fortress of a balance sheet. But they're not just sitting on the cash. They're using it to force this Warner Bros. Deal through.
Hmm?
And the update on the merger terms is aggressive.
It's a complete pivot. I mean, originally this was going to be a mix of stock and cash.
Right, the standard way.
In this new 8K, they've just ripped that plan up. It's now an all-cash transaction, valued at $27.75 per WBD share.
Moving to all cash just feels like they're terrified of getting stuck in regulatory limbo. It just screams that they want speed and they want certainty.
You're right. It definitely expedites the timeline a lot. But, writing a check that size requires liquidity that,
Yeah, well,
that even Netflix doesn't just have lying around.
which, of course, brings us to the scary part of this whole report. To pay for this, they're basically maxing out the company credit card.
They really are. They've secured a $42.2 billion bridge facility.
$42 billion. That's a staggering amount of new debt.
It is. And as a result, share buybacks are officially paused. They have to hoard every single penny to pay down that bridge loan once the deal finally closes.
It just puts immense pressure on them to execute perfectly. If you're carrying $42 billion in debt, you just can't afford to have a bad quarter.
Well, and that's where the ad tier comes in. That's become their safety net.
The secret weapon.
Exactly. Ad revenue more than doubled in 2025. It crossed $1.5 billion.
So it's becoming a primary profit engine right when they need that cash flow the most.
It is.
And all that money follows the eyeballs, right?
Yeah.
They finally crossed 325 million paid memberships.
Yeah, and the engagement numbers totally back that up. In just the second half of last year, users streamed 96 billion hours of content.
I think a huge chunk of that was probably the Stranger Things finale. I saw it had 120 million views for the final season.
Yeah.
That franchise is just a monster.
And it proves they can still drive the culture. That cultural power is what's allowing them to branch out now. They're not just a movie app anymore.
No.
They're securing live sports like the World Baseball Classic over in Japan.
Yeah, all 47 games. Plus, now they're launching video podcasts with partners like Spotify and The Ringer. It really feels like they're trying to become the default operating system for all entertainment.
That's the strategy, right? Keep you in the ecosystem no matter what.
Yeah.
But everything looks perfect on paper. Margins are up, ads are up until you look at the risks.
Right, and that's the big question. Is this hubris? Taking on $42 billion in debt right when YouTube is coming for their lunch.
And that's the danger. YouTube has the Oscars starting in 2029, and then you've got Amazon just pouring unlimited money into sports.
It's true. So if the economy softens, or maybe the Warner Bros. Integration gets messy,
That debt load becomes an anchor fast.
it makes you wonder, by absorbing Warner Bros., is Netflix just recreating the bloated cable bundle they originally set out to destroy?
That is the real long-term question, isn't it?
I think we'll have to leave it there. So if you found this breakdown helpful, please click like, share the video with a friend, and of course, subscribe to the channel so you can stay tuned for all our upcoming content. Thanks for watching.
See you next time.